There's still 25 people there, I think. 20, 1, 2, 3, yeah, 25 plus.
Good. That's a decent amount then. What's that compared to full capacity or normal?
It's probably kind of two-thirds, I think.
Yeah.
So yeah, but yeah, I'd say everyone's in the office, but it's just mainly kind of if people have got meetings outside of the office, but fundamentally everyone's now office-based again. So, just the nature of the beast, whether it be guys down on site or some of the consultants are with clients or just generally, kind of, out and about. So, but yeah, I mean, we were actually commenting because we had a wander into town just early this morning, and it's still pretty quiet, remarkably really, because the motorway and the A38 to get into the city is really busy. So, but yeah, it's some of the sort of, just some of the parking bays seem a bit quiet, whereas they would normally be all full. There's still, but whether that's, generally kind of people still working from home or whatnot. Yeah. Generally sort of getting back up to speed pretty much.
Yeah, maybe just a bit of a lag time, between everyone being allowed back and then people sort of getting used to going into the office again.
Yeah, I mean, the other thing, actually thinking about it, the other factor is the congestion charge started last Monday for Birmingham.
Oh wow!
It's as per London now. So it's obviously that will mean that. In fact, I missed that this morning when I was thinking there was a few less cars about. But obviously there's less cars because there's a daily charge now to come into the city. So that's probably more reflective of less cars, but lots of people, but less cars than anything to do with COVID, I think.
What's the cost, the daily cost of that?
It's currently £8, but rising. I think there's incremental rises. Am I the host? Am I due to let people in, by the way? Because I keep getting people pop up. So
no, I think
me, attendees, are these people. So currently we're okay. All right.
It does look like you're the host there, Joe. Yeah.
Yeah, no.
I think I am the host. Yeah. So if there's any questions, I think they'll come to me at the moment, which is fine.
Yeah, you don't, and I don't think you need to do anything. I think we've got people are all coming in now, so we should probably make a start. We've got a lady in Italy put a comment in the chat saying she can't get her webcam on, but good morning from Italy. Good morning, Joan. No need to put the webcam on, it's okay. Right, so what are we? Sorry?
Buongiorno.
Hey, bonjour. Yeah, buongiorno, Joanne.
It doesn't get much more elaborate than that, I'm afraid.
No, I mean, the accent
my Italian.
Almost 100% convincing.
Singapore, we've got Shauna Ball, Singapore. So good evening to you.
Good evening.
Betts in Jakarta.
China.
There we go, guys. It's a worldwide audience. So as always,
fantastic. Yeah,
as you know, we've got this is just more for your sake, I suppose. We've got probably mainly clients, 75%, 70% clients, 30% potential clients, and people just listening because they want to see what's going on. They're all over the world, as you've just seen: Italy, the UK, Singapore, China, all over the place. So yeah, as usual, good evening, good morning, good afternoon, wherever you are. How are we going to do it today, guys? I think in the past, we've maybe been a little bit guilty of just chatting away because we all love talking about property, and we've got lots of clients come in and they're always asking questions. So I think before have been guilty of maybe going on a little bit. So what we're going to try and do is just keep it short and sweet. We'll do perhaps around 20 minutes on just the general UK market and what's going on in the UK market at the moment. And, unless you've been living under a stone, you would know that there's massive growth going on in the UK at the moment. So perhaps we'll talk about some of the reasons why that's taking place and how you're finding it actually being on the ground in the UK, because I think that's what a lot of people listening would like to hear is from you guys, from the horse's mouth. And then we've got a list of really good questions from clients and from prospective clients talking about, off-plan versus existing properties, and a couple of specific questions on specific developments as well. So I think that's how we'll do things. For everyone that's listening, I think you probably know who these two lovely looking gents are, otherwise you wouldn't be here. We've got David Yadley and Joe Billingham, or Joe Billabong if you look at his Zoom handle, of Prosperity Property. So guys, so Joe, maybe starting with you, if you could perhaps give us just a little bit of background on yourself and maybe Prosperity, and then David, if you would be so kind as to do the same, that would be great.
Sure. So Joe Billingham, apologies for the title it's referenced. Yeah, so I've been in development 25 plus years, from small scale schemes, refurbishing houses, portfolios, and worked up to be the developer business that we are today, which is currently the largest developers in Birmingham, or homegrown developers in Birmingham, based on our projects, although we do take a national approach. So we've been very strong in PD, which is conversion of offices into residential across the UK. We've got a focus on Birmingham city centre currently, from a land bank perspective, as well as new homes, where we're focusing in the Norfolk area. So yeah, the business is kind of multifaceted. So we've got a sort of a direct and intermediary sales business. So we do directly retail our product, which is through Prosperity Wealth. We have an in-house mortgage business, and then quite a substantial now lettings and management business. Around 56% of our clients buy a second property from us within 2 years. So we like to hold the hands of our clients if they need it, sort of through the process. And 76% of our clients, 72% of our clients, sorry, work their way kind of through the process and are sort of managed within the Lamont & Co management business. So that is a kind of we try and offer a holistic view. So we've got very experienced investors with multiple portfolios, large scale portfolios that we've built for them over many years, to clients that are just starting out on their journey, buying their first property. So we've got the breadth of support to sort of help with either end of the spectrum. But as I say, those clients can kind of work their way through the process and into the sort of lettings and management business. So put some numbers on it. We've got a portfolio currently at just under 450 million. We've got around 1,200 new homes in the spectrum of either being built, under construction, in planning, in Birmingham City Centre alone, and then around 700 units of new homes, as in freehold homes. So that's our kind of range. And then outside of that, sort of smaller sites, which are PD, which are sort of typically a lower price point, higher yielding. But we try and have a product at any one time for for most clients, as well as owner occupiers. So that hopefully gives you a bit of an overview of kind of where we are from a developer perspective.
Super, thanks, Joe. And just quickly, I'm not sure if you mentioned it, but how long have you personally been involved with sort of managing and looking after property? Because I think you've been going a lot longer than Prosperity, have you not? I think that's good for people to hear how long you've actually been involved in property yourself.
Yeah, so that's probably 30 years now. So from starting out on sort of my own buy-to-let journey, refurbishing houses, and then we sort of built up a portfolio, buying, selling, renting, and then from there kind of looked at working with clients to sort of offer them a sort of quite a bespoke service back then. And then we were involved in raising some capital to start buying distressed assets, which we did that for a while. But the underlying objective was always to sort of be a developer. So we developed in the UK, and then we went offshore for a while. So we developed just over 1,000 holiday homes in Cyprus, for example, over a 5-year period. And then certainly in the last 10 years, we've been developing in the city of Birmingham, and as I say, UK as a whole.
Bro, thank you. It was a long time. David, tell us a little about yourself. Age, where you from? No, I'm only joking.
Age, not going to admit that to a large group of people, but I've been in, I suppose, financial planning and wealth management and property management now for over 35 years. So it's obvious that I'm older than Joe, so I can't conceal that any longer. Yeah, initially in the wealth management and financial advisory role, where I was involved in running a business in the UK and further afield, giving people holistic advice on wealth management, pensions advice, and so on. But I met Joe in, hard to believe now, Joe, but I met Joe in 2005, so it's 16 years ago. And Joe, in the space of a few meetings, convinced me about the merits of property, which, apart from buying my own home, of course, many years ago, I'd never really looked at, because I'd always been interested in investments in equities and bonds and so on. But Joe quickly galvanized my enthusiasm for property. So at that time, I was in a position to invest quite significant amounts of cash, and Joe quickly convinced me that the best place, the best home for that money was under his watchful eye. So I gave him some money to invest, which did incredibly well. So I gave him some more, and that did well, which of course made us great friends, as things success always does. So we got into business together in terms of managing a small portfolio of property. And then as I got to the stage where I was moving out of wealth management and my enthusiasm for property continued to improve, I decided to sell my share in a business and join Joe and try and become a property expert, which actually happened in 2014. So I've refocused my advice to clients more onto bricks and mortar as opposed to equities and bonds, at a time where I think that decision's been really, really good. The macroeconomic climate, I think, suits property investment much better than it does equities and bonds. And so I've rode along on the crest of the wave of a business that Joe has, developed through the difficult times into these very positive times now that exist, particularly for UK property. So my role today is really just helping, like an ambassadorial role, helping the business to grow its reach to the far corners of the world, and giving specific advice to clients as and when they need it, and trying to bring new connections, new advisors, new clients into the fold. So it's been a really exciting time, and obviously I'm closer to retirement than Joe, but I'll be doing this for as long as I'm able.
Great. Okay, gents, thank you very much. That's brilliant. That's perfect. I think we've got a good idea of your backgrounds and your experience with property, which is great. It's what people who are living over here in Asia like to see, that you have that experience and can help guide them make good decisions. So let's just jump straight into the UK market. What's going on there? I mean, obviously, well, it's obvious to us because we work in property. Property is going from strength to strength at the moment. A lot of people are saying that we're in the sort of 4 to 5 year boom phase of the 18-year property cycle, and that does hold true if you look at previous cycles. I've got a picture of a post you guys, Prosperity, posted up on your Twitter, I think it was a couple of days ago. House prices jumped 9.5% as buyers seek larger homes. That's from Halifax. Nationwide, I think at the end of May, said something similar. So what's going on back home in the UK property market? Is it true that prices are going up, that it's hard to secure properties because they're moving so quickly? I mean, as the people on the ground there, what's your experience of it at the moment?
I think I'll answer this one. I think just generally, obviously we can all kind of contribute. I think the key point, I think, when we talk about these very wide metrics, i.e. Halifax, Zoopla, Rightmove, they give a national average. And I think, like all things, you have to kind of look beyond the national average and really kind of understand what's going on in segments of the market. because if you take, there are areas maybe far north or certainly down south, sort of central London and around central London that sort of aren't particularly performing well. And then those have been outperformed exponentially by certain pockets. So I think it's just worth referencing that, I think, because it's, when you sort of take it, the market's gone up 7% this year, but there are a lot of segments within that, both from location and house types. So I think that's just a kind of a key point. So for us, I think we're in currently, Birmingham is obviously an area that we're very pro. So this is kind of quite biased, I suppose, but fundamentally, it's an area of drastic shortage. The supply and demand hasn't ever really kind of improved in Birmingham, and at the moment I can only see that getting worse, primarily for other factors, which I know we might come on to when we talk about the economy wider, but material shortages pushing up cost of materials. So you've got a lot of drivers in Birmingham. So if you look at sort of Birmingham, if you answer the question, what's happening on the ground, I think, as I say, taking out the variances of different locations, if we just look at Birmingham as an example, and then you look at the infrastructure that's happening, what drives capital values historically. So, key infrastructure changes, cities that become more connected, big events. So if you look at Birmingham, for example, we've got huge migration. So we've currently got the largest migration across the country of people moving to live and work in Birmingham. We've got the largest retention rate of students that come to one of our 5 universities and then stay, live and work. So there's a huge growth in population driven by employment. So we've become the kind of financial back office hub of the UK. So we've had HSBC, Deutsche, recently, KPMG last year, recently Goldman Sachs is the latest to sort of move their HQ. So part of the big city plan was to move employment and encouraging employment in Birmingham, and in effect sort of steal that sort of back office space on the proviso that it is 40% cheaper for an employer to have someone sat at a desk doing the same role in Birmingham than it is in London. So obviously there's a migration effect. That has now happened. So that's not something that's proposed. That has now happened. We had to build the commercial grade A office space to facilitate those people. And then what comes with that is both homes required in the city as well as the surrounding suburbs. So that's been a key contributor to Birmingham's growth. Alongside that, we've got a metro system, which is happening as we speak. We're on the 3rd phase of a 5-phase rollout program. So the connectability across the city has changed, drastically improved. And then on top of that, we've got HS2 connectability again, sort of, bringing Birmingham closer to the rest of the country in time scale wise. And then we've got the Commonwealth Games happening next year. So it's really a kind of a combination of lots of huge events that would drive any market individually, all kind of happening, together. So it's a really busy time in Birmingham. So that's just an example of kind of, what's happening in Birmingham that would be driving prices. Those are some of the reasons that sort of where you'll get a spike in Birmingham. Whereas, but if we're talking about central London, I mean, yes, it's improved of late, but certainly, London has been off by maybe 10-12% in real terms, transaction terms. People talk it up probably more than that, but the reality is, yes, there might be some deals that are sort of, where people are buying a lot lower than that, or the market's come off significantly. But I think in real terms, it's probably more like 12% in London. But that gets into the sort of the blend of average mean that then comes up with the 7% number. So certainly, our belief is, Birmingham, based on the infrastructure and all the things I've mentioned, and then new homes. And that's not, we're focused on Norfolk, but new homes generally. There's been a lot of impetus from the government in the UK. They're very much wedded to the success of the property market, with just the amount of debt the government's got in the market from the numerous schemes that they've run over the last sort of 5 to 7 years. That's still ongoing with Help to Buy, which has now been extended. as well as, currently, we've obviously got incentives for first-time buyers, and then we've recently had the stamp duty holiday. So a lot of these factors are, are driving certain areas of the market, but smaller new homes for owner occupiers, the first-time buyer market is very, very strong in lots of the UK. But yeah, that's a bit of an insight from a Birmingham perspective. And I know I've been told to keep the answers short. So sorry about that. I can see you trying to get in there, Callum.
If we're sticking to our 30 minutes, then we've got 10 minutes left. But no, I've just as you were going through. Sorry, there was so many good points and so many questions that I wanted to ask there as you were sort of talking. And I think that the main thing I'm getting from that, which I think is so important, and it's what people need to do when they're doing their research, is you don't just look at the overall figures, oh, well, the UK is doing 10%, because as you say, within that, there's going to be places that are performing very poorly, and there's going to be places that are performing much better. So you need to, it's imperative, that you need to do your research, or you need to look at research sources, Rightmove, Zoopla, you guys, us guys, Stu's Market Wrap, obviously I've got to say that, all these sources that give you good information to see where these specific locations are that are going to grow. You don't just look at the UK and go, it's all going to go up 10%. You need to do your research, so just briefly for me, one example of that, we've been doing buying a property from overseas mini series on YouTube. You guys might have seen it. I think we've got about 200 views on one of the videos now. And we looked at Nottingham, and we did our research, and we looked at house prices there one week, and they were I think for a 2-bed terraced house, existing property, we were looking at about £120,000 in the city centre. And then 4 weeks later, they're at £130,000, the exact same properties in the same location. So I think perhaps Nottingham's an example of somewhere that's perhaps exceeding that average in the UK at the moment. So do your research on specific locations. And then that leads into my other question, which would be specific locations. I mean, obviously it's your guys' business plan is to pick locations that you think are going to do well for you, but B, for clients as well. You need to make sure the figures work for clients, otherwise it doesn't support your business model. So how do you guys pick good locations? Where does your research come in when you're looking at new sites and new places to buy and new places to build? Joe again, or perhaps maybe David.
I'll just give a very short answer. I think for us, it's, I think the concern is if the market is frothy, I think you have to go with affordability. So you have to go with the baseline for large scale schemes are based on a fundamental employment base. People have to be able to live and work and afford to live in those locations. And then it's affordability. So you start with the fundamentals. Is it a location where there's a strong employment base, and then you look for affordability, because I think that's something that from a developer perspective that then the clients get the benefit from is that sort of security of knowing that if we want to be in the affordable end of the market, i.e. if it's new homes, we want to be in the 200,000 sort of mark, sort of to 300,000. We don't want to be in the 800 to 2 million price, so it's very much it's the bread and butter stuff, I think, and that I think, and for us, we're kind of looking for, we're looking for the sweet spot. So we are looking for capital appreciation, but we have to be mindful that, whether it be new homes or apartments, that, there's a strong enough yield there. So really, it's kind of it's a factor. But I think you start off with the fundamentals, strong employment bases, places where people want to live or rent. And then from there, you look at affordability, and then you really kind of just then looking at, sort of the optimum property or house type that, you can build in those locations that the market's requiring, really.
Great. Again, I think
the other point there, Callum, is the business 10 years ago was quite small, and the research that took place from the business was very much created from our own research. So somebody would say, go and have a look at Peterborough, and off we traipse to have a look at Peterborough. Whereas as the business has built some volume and gravitas and reputation, a number of property agents contact us saying, have you thought about this? And they provide us the initial research reviews to make us think about places that perhaps we wouldn't have thought of before. So our underlying principle is still, I think, the best driver for a good solid investment over the medium and long term is income yield. So if we can find compelling places where income yield is good, then we'll go and have a look at those and do our own research and verify the information we're being told by external agents. But we're getting opportunities put before us all the time now, and perhaps that wasn't the case 10 years ago, but now constantly we're being given new opportunities and new ideas, and it's up to us to look through those and sift through them to find the opportunities that best suit our principles of low risk, high yield, with the prospect of capital growth allied to those principles.
Great, thanks. Yeah, and it's good to know, that you guys are doing that. And I think, just to stress as well, a few takeaways I would say if I was listening to this for the first time, being a sort of potential or would-be property investor, what have we talked about quite a lot there in the past 20 minutes? It's research. You guys do your research, we do our research, we suggest other people do their research. And what are we looking for? Well, we're looking for the fundamentals. So population, employment centres, good yields, potential to go up in value. So, we're all looking for the same things here, whether you're a developer, whether you help people buy property such as ourselves, or whether you're someone buying property. So bear those things in mind if you're listening, people.
Fundamentally, I think that's we've always been very kind of key directing people to do their own research. And if you're confident in your product and you're confident that that your clients won't find, or the research will only sort of reinforce what you're saying, and obviously do your research, find out about the difference of where the market's moving, where there's plenty out there. I mean, you can sit on the internet all night, can't you, which is kind of a good thing and bad thing, but certainly that lots of advice out there. And I suppose it's a bit of a balance, isn't it, of kind of eventually kind of taking a view, but certainly the research only reinforces kind of, I think, what potentially we're
for sure. And it's, as you say, it's all out there on the web. And I think that's a good opportunity to plug two things. Firstly, your investor series, Joe, which I think is great. Guys listening, Joe and guys at Prosperity have been running a sort of introduction to buy to let sort of mini video series, which is great. You can sign up. Is it on the website, Joe, or? I
think it's available to all now. I think at one point there was a members only part of it, but I mean, certainly if you inquire, or if Callum, if you want to send a link out maybe afterwards, we can do that.
Perfect.
We have a 6-part series, and we talk to different professionals. So we kind of go through from either we had a lawyer in the first week, and just work our way through the professionals that form part of the process chain ultimately.
Yeah, and it's a good bit of education, and if you want to supplement that, guys, you can check out our APW course, which is done from afar, where we do all the research ourselves, and we call legal teams and management companies, and we put the whole thing together ourselves. So you can check that out and get an idea of how to do your own research. But anyway, there we go. That's enough of that. You mentioned stamp duty there, guys. Something we get asked quite a lot at the moment is, and I think everyone's sort of got their own opinion on it, but stamp duty and the stamp duty changes, what's going to happen come September, if indeed it is stopped and it's not extended again? What will the impact be, again, if any, on the property market if if and when the stamp duty holiday is stopped?
Do you want to go with this one, David, or do you want me to?
I can start.
The stamp duty holiday has undoubtedly stimulated the market through what's been a difficult time with Brexit concerns and, of course, coronavirus and the impact of the pandemic. And that was what the government intended for it to do. And I think it's been very helpful in that. But of course, the stimulus provided has been more to the general market than to the investor market. Yeah. And I'm sure most of the people listening in today are investor-led decision makers in terms of their property portfolios. and so it's raised interest in property, but it hasn't necessarily had a particular effect on any of the people who are buying property for investment or buying property from overseas. So we don't see a huge impact on the investor market. I think there's bound to be a little bit of a diminution in the amount of activity post September for first-time buyers and for owner occupiers. But I think what it's done is galvanized the fact that property is a fantastic investment, whether it's for your own home or whether it's for an investment. We don't see a major effect come October, certainly not in investments, and in the longer term, not in the owner-occupier market. That's going to continue to roll along because there is still this chronic and underlying shortage of property in the UK. And when you've got an excess demand and a diminished supply, that can only have a positive effect on any asset class.
Go on, Joe.
I was just going to say that I know that there are, we're talking offshore, but from a UK perspective, the UK stamp duty holiday finishes at the end of this month in June. Just to be clear on, I think just referencing that. So if there is I think there the tail off. Can you
clarify that? So there's the UK is different to the offshore. Sorry, what do you mean by that?
There's a my understanding. I mean, I'm very much focused on the June date, so I'd have to check exactly what, because there's been a few changes of late, and which kind of. It's a bit like there is a bit of protest about the fact that sort of how many times it has changed of late, or they've made it sort of quite confusing. Yeah. But there's a later date for offshore buyers, but we're talking here completion. So I don't think it would ultimately affect anyone that's listening to this call on any of investments that aren't going to complete before September.
Okay.
So unless you're kind of buying now, the likelihood that you would be completing. You'd already have a transaction, you would already know your position. So I don't think it's relevant for maybe, buyers as far as from a perspective of, savings. The stamp duty window closes at the end of June for UK transactions on completions.
Okay.
Got a question that's popped up now. So.
Yeah, I was just looking at that. Do you think that house prices will fall when stamp duty ends? I think we've just covered that a little bit there. I mean, it's not really it's
not really been relevant to the investor market, and then I think it's very much. I think it's mainly been upsizing. That sort of, and I think that ultimately all that's happening is, and if you talk to the agents on the ground, they're just basically saying that there's a potential sort of window of time where if someone feels they've missed out on what would have been the discount, they'll be saying to the vendor, I'll buy it at X price that they would have done the week before, but you need to cover my stamp duty. Yeah. So fundamentally, the transaction rates will continue at the same level. I think there's an obvious kind of urgency, and I know that one of the questions, and if I can answer that now, Callum, that one of the questions that you sent me was one of the clients asking about the contracts for one of their properties.
Yeah.
So that's we've been delayed on issuing contracts, or at least we've not been delayed on issuing them, but they have been a delay in the process based on, if you speak to any conveyancer and any law firm in the UK, they're all running around like headless chickens at the moment on the basis that once you give, there's a capacity of conveyancers in the UK. So if you then, we don't, it's not sort of something that sort of absorbs more work, but it doesn't particularly expand. So if you've got X amount of firms in the UK that deal with conveyance, they're used to dealing with conveyance of X amount per month or X amount per year. And then the government decide that they want to run one of these incentives and put a long stop date on it. And obviously then everyone's kind of rushing, and all property transactions, they're all kind of done at the death. And, so at the moment we've got trying to place volume with any law firm that you would want to work with in the UK currently is a challenge. We're actually extending our panel to a third member now. So currently we instruct around 600 plus cases a year of conveyance cases. That's our sort of, that's our sort of production rate, and those were allocated between sort of 2 firms to date, and there's due to be a third one, because this is something that's really, pointed out to us, that highlighted to us that we needed another firm to absorb times like this, where maybe there are a bit of extra activity in the market. So that's something that we will be adding, an additional firm to the panel. But obviously, like we just spoke about, we have to do our due diligence on the firm, we have to understand them, we have to obviously agree terms with them. So that's something that will be going live over the next sort of month or so. But fundamentally, I think, just to answer the question that the client asked, why haven't I received my contract, there is a delay in contracts at the moment, and that is very much born out of, at the moment, we're on stop instructing further opening further client files. There's a bit of a backlog, but as soon as June's out of the way, the tap goes back on with the 2 current firms alongside the third firm. So we'll clear down that backlog pretty quick. But fundamentally, the answer to the question is that due to the stamp duty cut off in the end of this month, obviously most conveyancers at the moment are kind of under a lot of files and trying to work their way through the ones they've got.
Great. Okay. Thanks for that. So I think that segues nicely into the client questions and the questions we've been sent in beforehand. If you just came to listen to general stuff about the buy-to-let market, don't rush off yet, because there is a lot of good stuff in these questions, a lot of good base knowledge, like off-plan versus existing and that sort of stuff. So stick with us for another 10 minutes or so, and we'll get through some other good bits. I'd just like to touch on and get your opinions on that question that came in. He said, will there be a fall in house prices when the stamp duty holiday changes? Well, I would say I don't really think so, but even if there is, I mean, if you're buying property for the long term, and I think this is something we spoke about last time, David, if you're buying for the long term, you're buying for that 10, 15, 20 year period, then what's a 1% drop? It doesn't really matter, and if you're trying to flip a property, if you're buying in June and banking on selling in 4 months when it's gone up 10% because Nationwide said it will go up by 10%, then something's probably going to go wrong. And
that market's gone.
Yeah. So I think
that market's gone. I mean, the costs now incurred on acquisition and sale. You can't flip property, even properties that make a good return over maybe 12 months. I think on stamp duty, we're actually talking about relatively low amounts. If you look at kind of, the sort of the first time buyer market, and that sort of, you're talking about maybe up to £10,000 in a lot of cases is the stamp duty sort of discount, and that's not sort of enough to. It's supply and demand at the end of the day, isn't it? That's not changed. If anything, it's getting worse due to, as I say, the shortage of materials.
So fundamentally, you would say we're in more of a buy and hold market now. That's what people should be looking at if they're looking to be involved in property.
Yeah, which I think it probably always has been, but I think there's probably been some of this kind of, and we all know get rich quick schemes fundamentally don't work, do we? So, the bottom line is, buy a property, let it pay for itself from its rental income, long-term pension play, long-term lump sum investment, but, get it managed and move on to the next one, or kind of, that's my view.
Yeah, if you want short-term wins, go for cryptocurrency.
Yeah, definitely.
There we go.
Come on our cryptocurrency seminar next week.
Yeah, we've got one of those as well. But that's it, guys. And if I think that is so important to understand is the long-term thing. And I personally even think that even people are trying to get good cash flow from property at the moment. I think just even if you're just breaking even if it's costing you £5 a month or £10 a month, ultimately it's a small price to pay for something that's going to be paid off in the future and giving you £10,000 a year in income. So anyway, there we go. There's enough on that. Right, what else have we got? I think off-plan versus existing, guys. So there's a whole question sent in here. It's given that you guys are specialists in selling units during the build period and developing off-plan for the overseas and the UK market, what are the key benefits to an investor buying off-plan, with or without you guys, off-plan in general, versus an existing unit or an existing property that's that's ready to rent or already rented.
Going for that one, Joe, or for me?
No, I was thinking people are probably fed up for listening to my brummy.
Yeah, I was going to say, David, we should hear from you a little bit, I think.
Okay, all right. I think the two investments, whilst I accept what you say, that we may come across as specialists in that market. Of course, the thing with a mature business like ours, which has been doing this for well over 10 years, is, and we're building projects all the time, is we've got completed stock, we've got stock that's just got planning permission, is 24 months from completion, we've got stock that's 6 months from completion. So our focus isn't just on off-plan. Off-plan was the centerpiece of what we were all about when we started, but we've become a business which has got a very large portfolio of available properties to offer people. So, and each different type of investment suits different people at different times in their investor journey. So I think the inexperienced investor who's thinking about dipping their toe in the water for the first time in investing in residential property, the idea of paying a modest deposit now and then paying some other deposit payments in uniform amounts over the next 16 to 24 months, and getting used to the property being constructed and understanding the mortgage market and doing their own research again on lettings management and how best to do that. It's an ideal low risk way of getting into that foothold in the property market. Whereas we deal with sophisticated investors who maybe have 10 or 15 properties, and their interest very often is, I need something now, I want yield now. Yeah. So the whole principle of what we're about is hand-holding our clients and your clients through the journey to building up a property portfolio and getting a balance of off-plan, modestly priced, short-term cost implications, but really modest cost implications in the early days, and then building up properties that you're going to own very quickly and start generating an income from. And it's trying to create that balanced portfolio that we're about. And so I don't particularly favor one solution or another. There's a short-term, quick investment in a property to generate yield we can help with, but also the off-plan investment is great. And if you look at it with a wealth management perspective, off-plan is absolutely fantastic if the macroeconomic climate is strong. So if you've got a market where the property market means that you're going to get maybe 3 or 4 or 5% growth in a property asset over the next 5 years, every year, then just making a very modest payment today to secure that price, and then paying a couple of £1,000 a month to build up your deposit to get a mortgage when it's completed in 2 years' time, you'll see the property rising in value, and that the exponential growth you can get on the money that you're deploying in that payment journey is really, really attractive if you create a spreadsheet. And that's what we do with our clients increasingly now, is work with them to explain how this will look in 2 years' time. And I think it's something that is increasingly attracting our clients to the offering we have of off-plan properties as well. But off-plan at the moment, I think with the market as it is a great opportunity. It isn't so good if the property market's falling. By rights, it's bound not to be, but we've got a really strong fiscal base and investment base. We've got low interest rates, which we believe will remain low for some time to come, because governments worldwide have to keep interest rates low for the average person in the street to continue. So it's a perfect storm almost at the moment, I think, for investors in the off-plan market.
Great, thank you. And I think the main thing there is there's another question about interest only or repayment. I think, and basically what you just said there is, David, is you buy for what your goals are, right? So figure out what your ultimate goal is and why you're buying and what your reasons are for buying, and then all those other questions will be answered. If you're if you're 65 years old and you want to retire in 2 years and you need income now and you've got a massive pot of cash to spend, then you're going to buy, as this question says, a completed house that's already tenanted, because that's going to give you income straight away and you're probably going to pay cash for it. But if you're much younger, 30, and you don't need another retirement income for another 40 years or whatever it may be, then you'd be silly to spend all your cash on a tenanted property like that. You might as well pay a small amount monthly, buy an off-plan property and let the tenant pay it off. You don't even know that it's noticed that it's being paid off. So I think, and I get very passionate about this, guys, you've got to set your goals, and then when you know your goals, you can work back from there. So that interest only or repayment, well, I think the person's in Dubai. What are you trying to achieve? Do you want an income from the property now? If so, then maybe interest only, or are you trying to pay it off? Is it more of a pension play? Then if it's a pension play, then it should be interest and repayment. So you need to define what you want from it, and then you'll answer those questions for yourself. So
it's also an interesting one there, that there's a risk profile issue there, because interest only means that somebody's cash flow is better. That doesn't necessarily mean they're going to spend it. They can therefore use their cash flow to buy another property alongside.
Yeah.
So it's all a matter of working out whether they believe that the macro climate supports buying as much property as possible at this particular time. And if they do, then there is some advantage in having interest only. Whereas if they're risk averse, then really I think repayments the solution to get the debt paid down as quickly as possible. I mean, we've all come from a background of our parents saying, oh, don't have a mortgage, don't have debt, because that was the view 30 or 40 years ago. But I think with low interest rates, you've got to match someone's aspirations and risk profile with the assets that you're buying and how you're funding and gearing up your transactions. Yeah. So there's some complexity to it, and I think that's why it's so important to have a good advisor like APW, or sitting down with you and helping you to build a portfolio and matching it with your expectations and your aspirations.
Yeah, and I would say at the moment, it is again, if you believe the property cycle and where we are with those sorts of things, then I would say it is a good time. We have got a good outlook of 4 to 5 years perhaps of good growth, but even then, if property prices aren't growing, people are still living in them and they're still paying you an income. So even if you're not getting that capital appreciation, you're still getting a yield. So
capital appreciation, I mean, prices can go up or come down, can't they? It's irrelevant really if the plan is to buy the asset under its own steam and then take an income from it. So I think fundamentally, but I take on board everything you both said there. I mean, I'm 49 now. I'm still buying property, but every property I buy is on a repayment basis. That's just my personal belief. But as we've said, it's a personal thing. But I just think at some point in the future, I want those paid off, and then you've got the asset, and then you've got the income, and whether that's a legacy for your children or income in retirement. But fundamentally, you need to get this debt paid down. So. And
that's good. That's good to hear. That's what people like to hear. That sort of experience and what you guys are doing yourselves. So that's interesting. And so Joe, you're just going to try and get as many as possible, have them paid off as soon as possible, and then
Yeah, I mean, similar to what you've mentioned. Started off when I was 18, but I mean the goals move slightly upward, but fundamentally, the kind of there's a key number that I want from a pure income perspective of properties that are paid off. So it's the same scenario. Work, so I'm kind of there or thereabouts, but certainly, but that aside, the fundamentals are that it's a long-term income aside from anything else you might have, your business or what your plans are. That's just to have a portfolio of property that will generate long-term indefinite income. I don't think there's much you can argue with that personally. However wherever you buy it from, or kind of but fundamentally repayment if you can, and it's a discipline thing, isn't it? It's will you really need that £200 a month, or kind of or that bit of income you get each year? sort of almost take some of the pain, and there has to be some pain. It might mean that you have to top it up by £100 a month, but in 15 years' time, when it's paid off, you'll be the one sat on a property that's paid off. You've seen the capital appreciation from where you bought the property will look very cheap in 15 years' time to where you bought it. I guarantee that. And then you've got the asset and you've got the income. So
brilliant. I love that. Thank you. All right, let's just fire through the last more specific questions on developments and things like that, guys, and then I think we'll let people go. Here's a good one. I'm decided on investing with Prosperity as the whole setup and support network is exactly what I'm looking for, but there doesn't seem to be a lot of choice in my price range of £100,000 to £150,000. Is there more coming?
Yeah. It kind of relates to another question that's popped up about materials, but it kind of dovetails into that. So, but yes, we are, we're on site on one of our, sort of current schemes, and then committed on numerous other schemes. I think at the moment we are, as a lot of developers are, probably pausing slightly, releasing further schemes, or moving forward with further schemes that based on the fluctuation of the current material and labour shortage, spiking costs.
Okay. And do you see there's a bit more on that question. I mean, how long do you see that that shortage and all of that sort of stuff lasting, or can you not tell? Is it just a case of?
Yeah, no, I think it's it's quite an acute problem, I think, at the moment. But we've seen some significant price rises. So at the moment, just to give you a bit of an insight to kind of where contractors are. We've got bricklayers currently on rationed mortar. So you currently can't buy or order more than 1 metre of mortar, which is about 2 days' work. So it's very difficult for a bricklayer, for example, or teams of brickies, to give you a timescale and a cost, because obviously the labour cost is the variance. So but if you need X amount of 1,000 metres, putting up, and you're on a 1 metre ration, it's very difficult. So that's one area of the market that's a challenge at the moment. So mortar, short supply, you're not able to order any en masse ordering, so we're restricted there. And then the trade is down now to sort of typically working 2 to 3 days a week. So that is only going to compound the problem of shortage in the market, and compound the problem of ultimately pushing prices up, in my view. We've got timber prices that probably spiked to about 70%. They're probably sort of down now to about 58% increase. So if you imagine the amount of timber and kit that goes into apartments, from kitchens, doors, skirtings, floors, it's a big proportion of any apartment or house scheme. We've got containers that were due for the UK redirecting to the States, because the States are paying about 20% more than the UK are currently. So we can't get anything with any kind of chipboard that's factored in. And at the moment, that again, so that's building a roof, for example, is a big challenge at the moment. Getting trusses at the moment is a huge problem. So, and it's all the little things that that compound the problem. So it's very difficult at the moment for developers to forecast prices. So yes, we can crystallise an exit value, and we know what we've paid for the land, but the big variance now is the contractor cost and materials cost, both from a labour and obviously just securing prices. So that there's a lot of developers on the back of that, as well as the PLCs that are now pausing sites, saying this needs to settle, which is a good thing, because it will take some of the demand out of the market. But it will ultimately mean there will be another shortage, because we're paying for COVID now. Ultimately, developers had a good year under COVID. As difficult as that sounds, but it's the road networks were clearer. We could get around a lot easier. We could get sites. We could get manpower to sites, material to sites. A lot of sites progressed very well. We utilised a lot of the supply chain that had got excess supplies, but that's gone now. We've had a year of shutdown, whilst we've used all that stockpile, now we've got no stockpile, and we've got factories in Europe and across the world gearing up to get back to production. But there's a year of productivity and a year of supply chain taken out of the equation. So we're paying for that now. We're not paying for it. We didn't pay for it last year, but we're paying for it now. That is going to be a shortage in materials whilst the market settles. But to answer the question, I think it's we've got to believe in market forces. We've got to believe that this will. There's a lot more production going on. A lot of people are ramping up a lot of production. So a lot of that will come. It's a bit like, it's very similar to the oil market, where there's restrictions, the prices peak, and then, as then they start sort of rolling out the barrels, the prices come off again. So I'm sure it'll stabilise, but for the next 12 months, I think it'll be a bit bumpy on, materials and the costs.
Okay, and what does that mean then for your developments that are already underway? So your St Mary.
Yeah, I mean, most of that. So, I mean, PD's pretty simple anyway, because you use a lot less of the raw materials and a lot of it. I mean, when we're starting a site, we've pretty much locked down the supply chain. So, we pre-order stuff. You can't order 5 kitchens, 3 weeks before you need them. You need to be ordering this stuff, 12, 18 months before you need them. So, our supply chain's, secure for all of our current projects. We've got no concerns on those, and then it will work through on the labour point, we're substantial enough where our contractor market knows that that we are an ongoing stream of work. If you're a sort of a smaller developer or a sort of someone looking to secure materials or labour on relatively low terms or low quantity terms, then it's very, very difficult. But as I say, and we wouldn't commit to something if we're not sure of the supply chain, and so we haven't got. And I do think in 12 months, the whole thing could have sort of sorted itself out. And alongside that, we do have algorithms within our appraisals which work through the inflationary numbers. And although we've re-inputted those, they change the overall performance of a site, but certainly don't make them unviable.
Callum, something that would be quite interesting for the listeners to hear, but obviously most of us, I think, are probably at some stage we're Brits, so there should be some patriotism. And one of the things that we are seeing is as a result of these changes, as a result of Brexit, is a lot of domestic construction taking place now. So because of some of the supply issues, we're seeing new businesses spinning out and starting to construct door frames and doors in the UK, as opposed to importing them from Spain, which has been going on for years. The same is happening with kitchens and bathrooms in the UK instead of Italy. And this all really augurs well for the UK economy over the next 5-10 years. It's fascinating to see how these big changes, like a decision regarding independence from the European market, may have an initial detrimental effect on supply, but then creates and regenerates industry in the UK, and that really does augur well for the future, and it's something we're all excited about.
Yeah, definitely, and genuinely excited. Genuinely, I think it's it's really, really encouraging. We're now we're invested in a business that's producing our own doors, for example, in Derby. That's a local business, and that's something that's going to employ probably 25 people by the end of the year.
That's cool.
And that's new manufacturing. I mean, we want to get to a point where we're kind of really waving the UK flag. We want to be able to say, developments, sort of, built from UK product, UK product, UK labour. That's something I'm very, very keen to bring forward. I think that is the way forward. But and from a developer perspective, the more control you've got over your supply chain, the better.
Yeah,
I think just to finish off on the kind of supply, why are we seeing this supply chain problems? Yes, COVID took out a big piece of the supply. We also had a UK DIY boom, as they did a lot across Europe. So a lot of the B&Qs took out huge amounts of supply. I don't know about you, but I've gone to B&Q, had to stood in 20-minute queues just to sort of buy a piece I needed for a tap the other week. It's just it's ludicrous. alongside that, you've got Brexit, so you've got all this sort of, the delay of getting stuff into the UK. We're building our own doors because I've got 585 doors stuck in Croatia, for example. So, which I can't get in the UK. So, all these, it's like the perfect storm just to sort of, but as David said, what's come out of that is a huge amount of impetus to get, the UK manufacturing underway, which is, it's already happening.
That's great. And as you said, supply and demand, free market forces. If there's a demand, the supply will be made to meet it. So that's interesting. That's interesting about the door company. I didn't know that. But okay, guys, we'll go into our last 3 questions, and these ones have got to be quick. They're all on sites. So we've got one on Mansfield, one on Broadoaks, and then one on Smithfield. So just on Mansfield, the Hive.
Just could we just determine which ones you'd want me to answer and David to answer? Because I've got an 11 o'clock meeting, so I'm going to have to leave this now. Shortly,
Well,
so
there we David, go. Why don't we say goodbye to you, and we'll just do the last 10 minutes with David.
Great.
It would be good to hear from him, actually, Joe.
Sorry. I haven't been that bad.
No,
I've tried to keep my answers relatively succinct.
It's been wonderful, and I think that's exactly why people tune into these sorts of things, and it's exactly why you guys used to come over and meet clients before COVID, is because they get to hear that from you. They get to hear exactly what's going on, what you guys are doing, your experience, how you'd be doing it, and it's all great information for people. So thank you very much. Appreciate it as always, and we'll get the next one booked in after the call.
Okay, well, thanks everyone for joining. I hope that was useful. Thanks guys for organising. There's another question popped up about Norfolk, so that'd be a good one to cover as well.
Awesome. Okay, all right then. Cheers, Joe.
Thanks. Bye-bye.
Bye-bye. Okay, David.
I just want to be. In fact, I'm going to have to leave this on, I'm afraid, with a blank screen. I'm mindful I'm the host, and what I don't want to do is end meeting for all.
Why don't you switch it to Callum as the host?
Yeah,
maybe
make me the host.
Okay.
Because that would be typically something that happens, right? You would leave.
Well, yeah, it was all going so well, and then all of a sudden I just cut it off for everyone. Struggling to analyst, right? Let's have a look. Callum.
Okay, so David, what just on the Hive site, Mansfield versus Nottingham. I'm the host now. Cheers, Joe.
Thanks. Bye.
Bye.
There we go. So Mansfield versus Nottingham city centre. What? That's a good question. What would your comments or thoughts be on that?
I think the simple answer is Nottingham city centre would be better than Mansfield, but that would be shown in a price differential as well. So there's a boom taking place in the East Midlands without question, and that's radiating out from Nottingham, and so it's affecting the little satellite towns like Newark, to a certain extent Leicester, and Mansfield, and so on. So there's benefit everywhere, but again, with an investment property, we mustn't get too sentimental about the location.
Yeah,
it is all about, does the price point make sense, and is the yield that's being anticipated really realistic and achievable? And then the economic environment around the location, will that support rising yields? Is there going to be an increasing demand for property, which means that rents will rise? And Mansfield's got a very strong story around that at the moment. So it represents very good value. Obviously, you can get comparable value on the satellite areas of Nottingham and out in the sticks around Nottingham. But Nottingham city centre is always going to be markedly more expensive than Mansfield. So comparing Mansfield with, for instance, Carlton, where we had, and then Sherwood, where we had our projects relatively recently, the price points are the same and the expectations for yield are the same. And there's some compelling reasons for why we think the rents are supportable at those rates. So it's down at the end of the day to where the supply is. And at the moment, whilst we're very actively looking, we haven't got anything in Nottingham. So it's difficult to compare Mansfield with Nottingham today, because there isn't anything that we can offer there that has a comparable price point and yield prospect.
And And yeah, I think that's a very good point. You know, firstly, you know, there's not really the space to, or the land, as you say, to be doing new build off-plan stuff in Nottingham city centre. And if you were to do it, it would require buying expensive land, which would push up the price of these units. You know, so if you're looking for a more entry level pay monthly type approach, then you're not really going to get that in Nottingham. Whereas further out.
And interestingly as well, we've got obviously the Hive is live, and whereas our Nottingham projects are, you know, they're a year out of date now. And whilst we're not saying that you can get rip-roaring growth in these places, what we have seen in Nottingham is price rises, you know, quite significant price rises over the last 12 months. So if we were offering Sherwood again today, there's no doubt that the prices would be higher. You know, so it's an interesting comparison there. Is the prices are edging up in these key areas like the East Midlands and the West Midlands, and that, you know, it's really well supported, these price rises, and we just see that carrying on for a while yet.
It is 100%. And again, if you go and watch my video, guys, on buying a property, I know everyone's dead keen to see that, but we tried to buy a property, and like I was saying earlier, it was £120,000, and then just a few weeks, a month later, the same area was £130,000, and that was in Nottingham. Bit of a rundown area, but in Nottingham city centre, in the inner sort of city area. So prices really are rising that quickly. And if you go and do your own research, you'll see that for yourselves. So don't just take our word for it. Last two, Downham Market, Norfolk, obviously solid Cambridge commuter location. It's your, you know, you're doing homes there as well as units. Can you tell us a little bit about that? Why that's we've got existing Broad Oaks buyers, and then we've got, I think, some potential people looking at it as well. So why is that a great site, and why have you guys gone down there?
I think Prosperity, I'm bound to be positive about Prosperity, you'd say, wouldn't you? But Prosperity has stolen a march, I think, on the investor market with Downham Market as a project offering. And I would credit, because he's not listening, I'll credit Joe with that. Because Joe, I think, saw an opportunity 12 months ago under COVID, under this pandemic, where there was definitely a flight to space. And people were saying, I don't want to live in city centres anymore. I want some green fields around me. I want places for my children. And Joe decided, a bit of a risk, but decided, why not take the investor market proposition to houses, and let's go and develop a site in an area where prices are relatively modest, but there are some really good drivers. One of the key drivers there is Cambridge and the proximity to Cambridge, very good railway links into Cambridge, and just Cambridge growing as an area with the technological industry that is growing in infrastructure all the time. Air Force bases nearby as well, so people on Air Force bases looking to live in their own homes rather than on a site. And these are the big drivers for us in Cambridge. But the key thing was, let's try and offer our investors, particularly our expatriate investors and our foreign national investors, and we haven't talked about the huge amount of money coming into the UK from Hong Kong at the moment, but that is a big driver for the UK market as well at the moment. But yeah. These people have been fascinated by the idea that you can buy a house as opposed to an apartment, secure the price for something that's going to be delivered 2 years from now, and end up with a house which you can then invest out to a nice solid investor market without the incumbent costs that you have with an apartment of leasehold costs and, you know, ground rent, etc. And so we went into that market in January, and my expectation was, I'm not sure whether this is a good time to be doing this. And as I say, this just underlines the advantage of having a very successful property entrepreneur heading up the business, because he saw something that the majority of other people didn't see, and that was that there would be a big demand for this type of product. So we've launched a site there with 300 homes, with an expectation that we'd sell those over the next 3 years progressively, and we've now already sold over 150 of them. Now that really exceeded anyone's expectation when we launched it in mid-January.
Yeah.
So it shows the appetite for that type of property. Any type of property, I think there's an appetite, so long as the fundamentals are right. The
And
location is
so
important.
It's those fundamentals again, those pesky fundamentals we were talking about earlier. And I think just to reiterate, Prosperity and you guys, you're the only people that allow people to buy property on the drip or monthly, but they're most certainly the only people allowing people to buy freehold houses on the drip as well. I mean, it's a totally unheard of concept. I was looking at other new build freehold houses around the UK as comparisons, and they all need much larger deposits, and they're not in as good a location. So they're the only people that will allow you to do that. So I think that's very important to remember. And as you say, when you're trying to be successful in building your property portfolio in life in general, it's not just about what you can do, but it's about surrounding yourself with a team of people that make you better and are better at the things that you can't do. And I think that's something Joe is very good at. Like you say, he's been doing it for such a long time, and he's always been successful in that. And as you say, this most recent site is a good example of that. And if you can work with people like Joe and David, ourselves, look at our knowledge, look at our research, and you can start building an idea yourself, and then you can make informed decisions on these sorts of things. So there we go. One more question on Smithfield. Thanks for that, David. I think that was great. Last chance, guys. If you've got any questions, chuck them in the chat or in the question box. If not, we'll do this. And one more has just come in. Smithfield, David, where are we with that? The Birmingham Smithfield site.
Smithfield is, if I'm frank, one of our great frustrations. We first bought a piece of land in the Smithfield Markets area. In fact, I can remember going to see the piece of land and the building as long ago as 2015. And the initial site was a property called Bradford House. And we were buying a building where we were going to apply for 61 apartments to be built in there, and thought it would be a really straightforward project that we'd deliver in about mid 2019, and here we are. We still haven't done that, but we continued to acquire land in that area. Smithfield fundamentally is a fantastic project, fantastic opportunity, but it is such a dynamic situation there because of its proximity to HS2. So Smithfield, we own about 10% of the total land area of Smithfield, and Birmingham City Council own about 80% of the rest. And Birmingham City Council didn't really see the golden nugget that they had there until we started applying for planning permissions.
Joe, you and Joe did.
So, well, I think possibly not as much as it's become. So the whole thing now is being redeveloped, and the Birmingham City Council are completely committed to redeveloping that whole area of land with the view of migrating some of Birmingham City Centre's core infrastructure further south into that area, because of course this infills the position between the Bullring and Grand Central Station and the areas that we know as Birmingham and HS2. So there's going to be a whole new community growing there. But because Birmingham City Council are now so excited about it and have created this new huge map of what they want to do there, and that is accessible on, if you Google Smithfield Markets, you'll be able to see the master plan that's out there.
There's a good video on YouTube.
And it is hugely exciting, but the infrastructure load that is there at the moment is so enormous, and of course that's been the whole progress has been suppressed by COVID, and undoubtedly, whilst developers in the property market have been able to to benefit from the COVID issues over the last 12 months, up until recently, certainly. Birmingham City Council and general government bodies have just seemed to implode during COVID. They didn't have the capacity to grant planning permission in the normal way that they would. They weren't ready for Zoom calls. The councillors didn't have mobile phones.
We weren't very ready about an hour ago, were we? So they're not the only
to a death, you know. So Smithfield will happen. What's the timescale? I'm tired almost of trying to provide solutions for our investors on this, because so many times I've made assertions that I felt were right and they've proven to be wrong. But we're told at the moment by Birmingham City Council that our final planning application, which was perfected and dispatched to them at the end of March, will be signed off this year, whatever that means, hopefully by the end of this year. For our Smithfield investors, what does that mean in terms of construction? I think we have to say that the earliest we're going to be delivering any apartments in Smithfield is going to be 2.5 years from now. I think that has to be the expectation.
Yeah.
Which is frustrating, just as frustrating for us as it is for our individual investors. But it will be worth waiting for. But yeah, I fully understand some people haven't got the propensity to wait. You know, they're frustrated. They need to have their money working for them in a more obvious way, generating income, whatever it is.
Sure.
So we're happy to talk to clients on an individual basis if they want us to, and I know we have in the past with a number of different of your clients. So you know, we can set up Zoom calls or meetings and come up with different alternatives.
That's it. Yeah, I mean the guys at Prosperity, you know, it's one of the reasons we like working with them, and as do our clients, is because they are very flexible. I mean, you don't get to have a Zoom call with you know, head honchos. Am I allowed to call you head honchos of you know, big UK development companies like this? So they're very accessible, which is great, and they do look after APW clients because we've known them for a long time. So you know, this is not just Smithfield, but with any development, and David probably won't like me saying this, but you know, if you do want something to be different, or you do want to ask, you know, just ask us and we'll see what we can do. You know, we're not saying we'll change the world, but we'll certainly try our best to make things work for you, because we want people to buy property, because that's you know, that's what we're here to do. You know, Prosperity develop them and sell them. We introduce people to them and give you the research and hopefully lead you to make a good decision about it. So we're all trying to achieve the same thing here. But anyway, last question, everyone, you'll be pleased to hear we've got no more coming in. No, it's been great, David, as usual. Thank you. Just last question. Will you be doing any similar projects to Broadoaks? And by similar, I assume that's houses, you know, maybe southeast, but will you be doing any houses anywhere?
Yes, we're very, very close. I can't be specific about the area, apart from the fact that it is east of England. So not far from Downham Market, but you know, within 50 miles, let's say. We're right on the cusp of securing a deal to do something very, very similar. Again, because of the success of Downham. So very exciting. And
we will no doubt get exclusivity for a while.
Yes.
Perfect. Thank you. All right then, guys. Well, there we go. Yeah, thanks again, David, as usual. That was brilliant. I think we've covered off a lot of the Prosperity specific developments, you know, your USPs, why you guys are a good company. I think there's heaps and heaps of stuff in there just for people that are new to property, and some gems you can take away as to fundamentals to look for, you know, goals, things to be looking at. I mean, Joe talking about the way he's doing it, and I've certainly find that interesting because he's been so successful with it. You know, he'd be a good person to replicate. So lots in there. Thank you so much. And if we can do another one in a month or so, that would be great. And then hopefully, maybe, who knows, you guys will be allowed over to Singapore and the Far East before the end of the year.
Yeah, I'd love to come back over, there's no doubt. So, but yes, thank you for those of you that have stuck it out for an hour and a half or whatever, but I hope you found some of it useful.
Superb. Thank you very much, David. We'll speak soon. Thanks everyone for listening, and have a good evening or good morning, wherever you are.
Bye.